The Federal Reserve has an official story for why they're keeping your interest rates high. But if you listen closely, the Fed chairman himself has pointed to the real reason, the one that's complicating everything. And in the next few minutes, I am going to show you what he said and break down the powerful economic forces that are actually shaping your financial future. You feel it every day. Your mortgage, your car loan, your credit card bills, they're all painfully high. And every month we look to the Federal Reserve for some relief, for a rate cut that could ease the pressure. And every month the answer is not yet. They say they have their reasons, a clear economic story that justifies the financial squeeze. But what if that story is missing a key chapter? What if the biggest reason is one they can't easily control? Stick with me because we're about to look at what's really going on. Section 1, the official story they're selling you first. Let's go over the official narrative. It's the story you hear on the news and the one Fed officials repeat in every interview. It all boils down to two things: the dual mandate. Congress gave the Federal Reserve two main jobs: keeping employment as high as possible and keeping prices stable. On the first job, maximum employment, they're basically taking a victory lap. The job market has been surprisingly strong, with unemployment near historic lows. We've seen steady job growth and wages are even managing to creep just above inflation. So if most people who want a job can find one, what's the holdup? The problem, they say, is the second job: stable prices. Their target for inflation is a clean 2%. Right now, inflation is being stubborn. After a long fight, it's still running hotter than they'd like, with the latest numbers for June 2025 showing an annual rate of 2.7%. Core inflation, which takes out the volatile food and energy prices, is also hovering between 2.7% and 2.9%. This is the justification they give us. Cleveland Fed President Beth Hammock put it plainly: we are hitting on our employment side of the mandate. We're not there yet on the inflation side of the mandate, and so I think it's important for us to maintain a restrictive posture. So the official line is simple: we can't risk cutting rates and letting inflation surge again. We have to be patient. We have to be, in their favorite phrase, data dependent. It sounds responsible and prudent, like they're protecting the economy, but it's not the whole story. Section 2, the factor they can't ignore: the official story is neat, but the real world is messy. And in his public statements, the Fed Chair Jerome Powell has openly acknowledged the messy part. He pointed to the real variable that's complicating the Fed's decisions, the one thing that has thrown their economic models for a loop. It's not just about the inflation numbers we have today, it's about uncertainty, specifically uncertainty over one massive, unpredictable force: tariffs. In a recent press conference, Powell acknowledged that the Fed is in a cautious stance, not just because of current inflation, but because of where new trade policies could push it. He stated that while there have been developments, uncertainty around the changes and their likely effects remains high. He then added, "We are well positioned to wait for greater clarity. This is the key. The head of the world's most powerful central bank is saying that they are being forced to wait and see how a political trade conflict unfolds. This isn't just about being data dependent anymore. It's about being policy dependent. Their decisions are now linked to something they have zero control over." Economic analysis suggests that significant tariffs, like those imposed in 2025, are expected to push up the prices you pay. The Fed knows this is a risk, but they don't know exactly how bad it will be, how long it will last, or how everyone will react. Do they cut rates to help an economy that's being dragged down by trade friction, or do they hold rates high to fight the inflation the tariffs could cause? This is the Fed's difficult position. They face the risk of both slower growth and higher prices, at the same time the dreaded specter of stagflation. And admitting that your policy path is heavily influenced by unpredictable political moves is as close as a Fed chair gets to saying, "We're navigating in a thick fog." This is where things get complicated, and it's why understanding these other factors is so important for protecting your money. If you want to stay ahead of these economic shifts and get the story the mainstream news often misses, take a second right now to subscribe to this channel and hit that notification bell. We cut through the official narratives to give you the real story. Section 3, Decoding the Truth, the Three Overlooked Pressures. That acknowledgement about tariffs opens the door to the other pressures weighing on the Fed. It's not a simple calculation of inflation versus jobs. It's a complex mix of politics, corporate strategy, and market psychology. First, there's the challenge of political independence. The Federal Reserve is designed to be independent of politics, but it's facing very public pressure to cut rates. Former President Trump, for example, has openly criticized Chair Powell, calling for deep rate cuts. This puts the Fed in a tough spot. If they cut rates now, they risk looking like they've caved to political demands. The moment the world thinks the Fed is just a tool of the White House, its credibility, its most important asset, is gone. Losing that credibility would hurt the economy far more than a few more months of high interest rates. So holding rates steady is partly an act of institutional self-preservation, signaling that they're still the ones in charge of monetary policy. The second factor is the corporate stockpile effect. While we wait to see the full impact of tariffs, many businesses have been making strategic moves. In the months before the tariffs hit, companies reportedly went on a buying spree, stockpiling imported goods to get ahead of the price hikes. This is a smart business move, but it creates a temporary illusion for the economy. It has likely blunted the initial inflationary shock, making it seem like the tariffs aren't so bad. But the Fed knows those inventories will eventually run out, and when they do, the real price increases will hit consumers. They are likely waiting for this other shoe to drop, refusing to cut rates based on an artificially low inflation number they suspect is temporary. Finally, there's the Wall Street expectation game. Financial markets have been anticipating rate cuts for months, and investors have made bets assuming the Fed would eventually provide relief. The Fed has to manage these expectations carefully. If they cut rates now, it might not be seen as a sign of economic strength. Instead, it could be read as panic, a signal that the economy is weaker than they've let on, which could actually trigger a market sell-off. But if they hold rates steady for too long, they risk angering those same markets. The Fed is walking a tightrope, trying to communicate its strategy without spooking investors. A large part of its decision making isn't just about economic data. It's about psychology and maintaining stability in the markets. Section 4. What this means for your money. So, what does all this, the official story, the tariff uncertainty, and the political games mean for you and your wallet? It means the financial squeeze is likely to continue for longer than many had hoped. When the Fed keeps interest rates high, it means higher borrowing costs for you. That variable rate mortgage payment stays elevated. The dream of refinancing your home to a lower rate remains on hold. Car loans are more expensive, making a new vehicle a bigger financial hit, and the interest on your credit card debt keeps piling up at a punishing rate. Now you might look at your high yield savings account and think, well, at least I'm earning more on my cash, and that's true. But the tough reality is that the very inflation the Fed is fighting is also eating away at the purchasing power of those savings. That 4% you might be earning doesn't feel as good when prices for everyday goods are climbing by nearly 3%. Ultimately, this period of high rates, driven by this complex mix of factors, puts your financial life in a holding pattern. Major decisions that depend on financing, buying a house, starting a business, making a big purchase, become more difficult and more expensive. You are caught in the crossfire between the Fed's public fight against inflation and its quieter struggle with political pressures and global trade uncertainty. So let's pull it all together. The Federal Reserve wants you to focus on a simple story. Inflation is too high, so rates must stay high. But the chairman's own words point to a more complex reality. His acknowledgement of the profound uncertainty caused by tariffs shows that the Fed's decisions are being influenced by forces far beyond simple economic data. The real reasons they won't cut rates are a tangled web of pressures: the fight to maintain political independence, the knowledge that corporate stockpiling might be hiding future inflation, and a delicate psychological game with Wall Street. They are stuck in a difficult position, caught between the risk of letting inflation run hot and the risk of slowing the economy down too much. For now, it's our wallets that are paying the price for this uncertainty. The question is no longer if they will cut rates, but what combination of events will finally force their hand. What do you think is the main reason? Is the Fed being smart, or are they stuck? Let me know your thoughts in the comments below. And if you found this breakdown helpful, be sure to check out our other video on how to invest when interest rates are stuck in limbo right here. Thanks for watching.